Roblox Corporation, symbol RBLX on the New York Stock Exchange, operates a user-generated online gaming platform where users can create, share, and play games developed by a global community. The company generates revenue primarily through the sale of its virtual currency, Robux, as well as advertising partnerships and premium subscription services. Last time we covered the stock in April 2025. It was going on a run. The shares were doing great. But now sentiment has completely changed. Roblox is down 57% over the past year to $47 a share, a $33.7 billion market cap. There was a big share pullback after Q3 2025 results and more recently after the Q1 2026 results, but there's been just an overall general decline. If we look at just a longer term chart, the stock really has had its post-IPO run up, fell back down, and then it ran up in early 2025. The shares are, however, currently really in that trading range that similar to the post-IPO correction from early 2022 through late 2024 before the last run up. So just interesting that we're back to where we were, despite the company has actually grown in size on revenue and user count and so on in bookings. But we'll look at the financials to see why that is the case, why the shares aren't really any higher than what they were previously. So revenue for Q1 2026 was up 39% to $1.44 billion. A strong top line result driven by user growth, improving monetization across regions. Share of developer expenses have shifted higher, however, as a share of revenue to 29% from 27% over the past year. They are down sequentially from 34%, but we have seen this trend of shifting higher and higher for these developer expenses as they need to pay developers to entice, because they are third parties, to create new games, update their existing games on the Roblox platform. And it's almost, which I would see like a kind of a royalty or a commission type of system, because it is variable to how many Robux are spent on the game, which is very different than a traditional game studio, which this structure can actually create more of a drag on scale as the cost is variable versus fixed. Normally you pay your developer, your game designer a fixed salary, maybe some bonuses, but it's relatively fixed, versus this, they're completely on a variable rate. Bookings were up as well, 43% to $1.73 billion. Normally, US and Canada bookings are falling as a share of revenue or of bookings, however, at now 52% in the last quarter compared to 60% in the last year. This is key as US and Canada, it really dwarfs on a bookings on a per user basis. So it is at $38.93 compared to $14.33 in Europe, $5.47 in APAC, and $5.12 for the rest of the world. So over 7 times compared to APAC and the rest of the world. So while it is good to see having user growth, the high valued region is just growing at a slower rate compared to the rest of the world. Some of that is likely due to some age check friction, which they've rolled out to verify ages, and it's been more aggressive in US and Canada. But it's been a longer term trend as well, shifting to these lower bookings per user regions from the US and Canada, which is just much higher value per user. You still do need the infrastructure and the fixed costs to support these user bases. So when you have a lower monetizable group, it is more difficult to scale and get that economies to scale. On the GAAP side, it's still a loss. The consolidated net loss was $248 million compared to a net loss of $216 million last year. So further into loss, with an EPS of a loss of 35 cents compared to 32 cents. Just that's not where you want to see that trend going. Adjusted EBITDA came in at $99 million, up meaningfully from $58 million the past year. The primary reconciling item, however, which I'm going to really focus on this because it's something which we've mentioned time and time again, remains to be stock-based compensation, which it was $275 million in the last quarter. That is a substantial, and it's been a recurring charge that continues to obscure really these operating progress at a GAAP level, which we would prefer. So stock-based compensation really has been a theme and a recurring expense since the company's IPO. On an adjusting cash flow metrics where they're not impacted by stock-based compensation, and on cash flows actually makes it look better. It looks much better than the GAAP figures. As well here, I do have highlighted a $57 million legal settlement, which was due to age issues, and we'll get into that in a minute. And moving into some key performance operation indicators, they were generally strong, though there are some nuances. Daily active users rose 35% to 132 million. Hours engaged rose 43% to 31 billion. And average monthly unique players increased 52% to 30.7 million. And average bookings per daily active user came in at $13.12. So there's your average figure compared to the much higher figure for the US and Canada section. And that's up 6% year over year. But that figure has maintained relatively flat. It's just some quarterly volatility around that $13 range, plus or minus a few cents or a few quarters. On the user cohort side, management has had this deliberate aging up program, getting higher, older audience, and it's starting to show. The 18 and over segment now represents 26% of daily active users who have done the age check. This is what the figures they're citing, but it is still the smallest segment. But the cohort has grown 50% year over year, faster than any other age group. Notably, the over 18 users in the US monetize more than 50% higher than the under 18 users. So that's an important long-term driver. If management can consider you to scale in the older demographic, you get higher spend, you have more dollars in your wallet to spend, or dollars in Ryan's wallet to spend. However, it should be noted that child safety has been a persistent issue with the company. And it's been a concern, obviously, when you have kids even as young as under 8. It's a very key issue, and you have parents obviously rightfully concerned, and it's a difficult and fine line to walk when you are looking to age up the audience. As I said before, just in the prior quarter, the company settled $57 million with various states in the US. So aging up is a deliberate aspect for Roblox for years now, and it likely will be going forward. I can't see any reason for it to change. And it is becoming just a generally older game. It's been around for nearing 20 years now. I think it was 2007 or 2008 when the original Roblox did launch. So despite the continuously updating games and contents, the audience that has been playing in some cases over a decade or so needs to be retained. They need to be monetized because this audience is very key to Roblox going forward. However, daily active user growth did decelerate from the roughly 70% rate seen in the prior 2 quarters. And management has been very transparent about this, about the global rollout of age checks. So that's are you actually the age you say you are, to access chat and other features, various games, has created more friction than previously anticipated. And this is not just for users who have an age check, but the second order effects of communication density and organic app store signups. So if it's a friction for one client or user, then they might not have a word of mouth to their friends, their family, and so on. So it's a self-inflicted headwind more than anything, and it's a deliberate safety strategy, which we'll see if that is successful going forward. Do we start to see less of a concern around the platform, around safety, especially when you are looking at this aging demographic? Shifting to the balance sheet, the picture here is a clear strength. Total cash equivalents, and investments, which are just treasury bonds and bills, with net cash and subtracting roughly 1.6 million in long-term debt and leases, comes out to 4.5 billion. That's a very well capitalized position. No concerns there. On the deferred revenue side, I do always want to highlight this as the liability does now stand at $6.8 billion across current and long term, as this reflects Roblox purchases where the revenue hasn't yet been recognized, but they do receive the cash for a front. So Ryan goes and spends $30 in Robux until he spends on his favorite hat or dress. It's not recognized as revenue. So it does create a bit of a lag on the GAAP revenue, but you do see it in the cash flows. But it has been services that haven't been rendered. They haven't, that 30% or so developer cut, depending on the exact program, but we'll say 30%, hasn't been paid out yet to them. So you can really see 30% of that cash should disappear. So you're looking at a bit over 2 billion once it were to be actually paid out to the developers for their portion of the fees. And now moving on to guidance, which has been revised lower as of Q1, with bookings growth being slashed from a range of 22 to 26% to the current 8 to 12% growth, which obviously big factor when you are looking at a growing company, when the valuations are reliant on growth. That shift is a very big negative. So the updated full year 2026 guidance is now a midpoint of $6 billion in revenue, representing 20 to 25% growth. Bookings of 7.33 to 7.6 billion, representing that 8 to 12% growth. A consolidated net loss still of 1.035 billion to 1.175 billion, so just over a billion to 1.2 billion loss. Adjusted EBITDA of 185 to 325 million. That's significant year growth of 48 to 160%, but it's because it's near that break even portion. And as well, free cash flow of 1.05 to 1.275 billion, which is actually now a decline of 22% on the low end to a decline of 6% on the high end. That's not great, even though they are still receiving their cash up front. And that's been actually a really big focus on the more bulls of Roblox is, and you can look at the free cash flow they're receiving upfront, clear benefit, but now you're not seeing the growth on that line item. As well, management expects daily active users to continue to decline sequentially into Q2, then return to a sequential growth in Q3. The Q3 recovery assumption is based on the seasonal tailwinds, planned product enhancements, and communications, and they expected that the age check friction normalizes. The bookings guide cut management states is largely an issue at the top end of the funnel. Existing user engagement and monetization have actually held up, and we do see that through the financials. The per user metrics are fine, but the issue is the reduced new user signups. You don't have a gaggle of 20 new Ryans signing up this quarter. You only have one or two, which management traces to the communication restrictions, dampening organic word of mouth growth, and impacting App Store ratings. On valuations, it's still not cheap. Using the forward management guidance, price to sale 5.6 times, price to free cash flow of 29 times, which when you are looking the ballpark range of 90+% of the free cash flow being from share compensation, that's still not inherently cheap. 29 times, if it didn't have that metric, I'd be okay, that's a bit more interesting. But once you are considering that their free cash flow is really being powered by share compensation, that is appealing, and you can see that in the EV of 150 times, why there's that big separation gap. All very expensive, still no gap earnings or expectations that are this time by us for gap earnings. So Roblox's bull case has always really been this growth story where you can grow, you can scale, and then you get a free cash flow after that. So a slowdown in growth is why the stock price gets hammered, and it has, rightfully so. So we've covered Roblox now a few times before and continue to really see that same profile. We're not seeing that inflection point to like this organic, not share-based compensation cash flow or no gap earnings, same inability to profit, but they do have an ever-increasing user count, but you also have an ever-increasing share count. The company is facing growth slowdown now, which is an added concern, which is why when we are looking at these growth companies, we want to see a clear path to profitability, not just an EBITDA story. The free cash flow has always looked better than other metrics due to cash upfront nature and the heavy share compensation, but now even management's own guidance is expecting a decline, which is a real concern and moving in the opposite direction of what is desired. The platform does have a real pull and a unique opportunity with that aging audience, with more cash in the wallet to spend. But that is coupled with child safety risks, which I don't think are over, at least yet. I think we are going to see, whether it's in the US and Canada and Europe, it is a fine line to walk. We're seeing more and more around social media. Roblox can sometimes be coupled into that. So whether or not it is over or not, or whether it's just changes, we'll have to wait and see. Overall, we will still continue to monitor Roblox, but we need to see per share profitability, not just EBITDA, not just free cash flow. That's really being powered by shareholder dilution and financial metrics that only really look good if you ignore real expenses. That's what we want to see going forward, is profitability at the end of the day. And for disclosure, we do not have a position or relationship with the company.
We must protect the children.
It's true. I mean, yeah, it needs hyper growth. It needs high-end growth and that is the fear. I think that's like of the market right now. Growth slows.
Mm-hmm.
You know, if it reignites again.
Yeah, you'd be kind of making a contrarian bet right now that, you know, they can kind of, you know, get through the safety rules and, you know, continue to monetize. But like, I don't know. I think this is going to be a headwind for a bit, for sure. At least in my opinion. I mean, we'll see.
Yeah,
but,
Canada's rolling out some social media restrictions. Australia's done it. I think it was the UK was the other country that I was seeing headlines on. So it's a very real risk. Yeah. And I don't think it can be overlooked.
I think like the thing too is like I've heard kind of stories in the past where parents don't even really or didn't even really understand that, their children might be speaking to somebody, through
Yeah,
Roblox,
no,
for
they
example.
don't. I
Well,
mean, some that I mean, some do, and they limit it. So, I mean, you can do things to prevent, but a
Mhm.
lot have it open, right?
yeah,
Yeah.
And
and
we're
that's where
talking
that
for like 8-year-olds, and
Yeah.
yeah, and that's where that age check comes in. Is it actually an
Mhm.
8-year-old? But then it creates that friction, and that's what we're seeing here. And
Yeah,
is that going to keep going forward? Are you just going to see people just not want to sign up because they just don't want to deal with it?
Yeah.
Mhm.